After careful review, your loan was not approved. And now you're confused. You done done everything. You fixed your credit, you paid down the credit cards, you done done everything that you were supposed to do, but why are you still denied, right? Most first generation home buyers think that buying a house is only the credit score, but it isn't. Today, your lucky day. Today, I'm gonna show you what the actual number they use to get you approved or denied. Is way more important than your credit score, so make sure you watch the video all the way through, okay? And today, we're gonna cover something that nobody ever talked to you about growing up. They tell you, get that good credit score, but they never tell you what the hell is DTI or DIT, the debt to income, all of this stuff you just never heard of, but we gonna cover that today. Once you learn to understand it, you're gonna feel like you're in total control of when it's gonna be time for you to buy your house. So I tell you what, let's get into it so you'll know what the hell is a debt to income ratio, okay? Okay, let's help you stop killing your home loan application with just thinking it only takes a credit score. So you done worked hard to build your credit score. Everything looks solid based upon the score. I mean, you ready to get that first home. Then the lender hits you with a denial and you just be like, man, it feels personal, right? But here's the truth. Your credit is not the main deciding factor. I've seen people get denied with a 720 and some approved with a 680. But why, right? Because banks care more about whether you can actually afford the payment. And that's what DTI measures. Credit score helps, but DTI is what they make the decision from. Okay, guys, so here we go. That secret number, here it is, your DTI ratio. Okay, your DTI, your debt to income ratio, simply is this. How much debt you pay every month divided by how much money you earn every month. It answers one question: can you really afford this house? Here go an example. If you make $5,000 a month, but $3,000 already go to other bills and loans, you do not have enough room for a $2,000 mortgage. That's why the bank says no, not because of your score, but because there's no breathing room. This is why you can have good credit and still get denied. This is why someone with a lower credit score but lower debt can get approved. Your DTI is your financial breathing room. When it's tight, the lenders get nervous, and when it's open, they feel safe and they approve you, all right? Okay, so now let's break it down. How do you get your DTI number? Let me break it down the simple way. Step one, add your monthly debt payments, not groceries, not gas, not Netflix, just real debt. Credit cards, car loans, student loans, personal loans, child support, or alimony. Example, like you got $200 credit cards, $350 car note, $250 student loan, with a total of $800 in debt payments. Step two, find your gross monthly income. That's your income before taxes. So if you make $3,000 every 2 weeks, that's 3,000 times 2, that's $6,000 in monthly income. So now you'll take that $800 and divide it by the 6,000, multiply it by 100, and then boom, your DTI is 13.3%. Okay? Now, the question becomes, is that good? Is that bad? Is that blocking your approval? Okay, so now that you're getting a better understanding of what a DTI is, let's figure out, where do you stand, right? Your DTI possibly falls into one of these three zones. A red zone, which is 43% or higher, automatic rejection territory right here. It tells lenders you have no room left in your budget, right? You're in a yellow zone, which is 36 to 42. You might get approved, but the rates, probably won't be that great. You'll get, fewer loan options. Then if you're in that green zone, 35% or lower, this is where banks smile. You get the lowest interest rates, the better terms, and the easier approvals. And here's the crazy part. On a $300,000 loan, the difference between the green zones and the rates in the yellow zone can cost you over $95,000 across 30 years, okay? So DTI is not a small deal, okay? It's a life-changing number. So, hey, stop, rewind, focus, do what you got to do to understand which zone you in, okay? This is the part, that a lot of people wish someone told them sooner. These three mistakes raise your DTI or mess up your financial file even when you have good credit, okay? So mistake number one, unstable funds. Moving money around, large deposits, transferring money between accounts. Lenders hate it. Like in some cases, they say it has to be seasoned, meaning, like they say, it has to be in there around about 2 months. And any big deposits over 1,000, requires documentations. So, this is the quiet period. Let that money chill. for a little bit. Then you got mistake number 2, taking on new debt. This one hurts a lot. You know what I'm saying? Even first generation buyers, you get approved, you excited, then your car break down, or you see a furniture sale, boom, you open that new account, just kill your DTI, and that new debt pushes you from green to yellow or yellow to red. Then the bank checks your profile again right before the closing, and then the loan disappears. They just turn it from approval to denial. So freeze your profile for 6 months before applying. No new credit cards, no new car loans, no furniture, none of that. And then mistake number 3, no written down budget. This one is not talked about enough. Most deniers could have been avoided if the buyer just had a written budget 90 days earlier. A budget is not a punishment. It's a strategic tool, and it helps you. Track every dollar, identify the cuts, create a debt payoff plan, and build your down payment at the same time. That alone can help your DTI go from a 40% to a 34% and save you, $50,000 in interest over time, okay? All right, now watching this video, you just learned that your DTI is your superpower. Now that you understand it, you're not walking into the home buying process blind no more. You know what your target DTI is 35% under. You can do it, right? You need at least 6 months to prepare. It's a process. You don't just walk up and just say, I'm going to buy a house. Hopefully this helps you make that decision a whole lot easier for you. You can save up to $50,000 or more just managing that number a lot better so that you can get a better interest rate. So you're not behind, you're not broken, you're not irresponsible, you just wasn't informed, until now. So hopefully this helps you. Make sure you follow me, connect, and let's build, right?